Hey, what's going on, everybody? So this is the course, and over the next few videos, you're probably in level one right now. Okay, so what level one is going to consist of accordingly is going to be everything that I use from the basics of trading Forex into the more kind of intermediate things. This video here is going to start off with trend lines, understanding trend lines, because what you probably already understand as students and the purchasers of my course and customers, you probably already understand a basic portion of Forex. So what I'm going to do, I'm going to not waste any time. I'm going to get right into understanding how to draw these trend lines because they're going to be the most important things that we're going to utilize in the course, or one of the most important. Um, Trend lines can be used through a various array of activities. What I like to do also, I like to go on the weekly time frames, and what I like to do is I like to look for any significant trend over a previous period of time, and that previous period of time equates into more or less long-term projections, because nobody wants to really sit around and kind of just like wait on the charts for like the whole day. People kind of just want to like make their trades and go on with their lives, because we lead very active lifestyles. If you're a trader, you have probably a bunch of different things to do every day. I know me myself, I don't like to sit in front of the charts all day, but some people can. Some people can do that. And if that's you, that's perfect. This technique can be applied to smaller time frames, so you can wait for those balances off the trend lines, or you wait for prices to come within those termination areas, and then you can make your analysis off that. So moving on, I'm gonna go forward into drawing trend lines. So particularly how you draw a trend line is very actually simple. And if you're coming from that world of fundamental analysis and you haven't really put any time or really a lot of thought into how to understand trend lines, and you've been solely working off of news or fundamental news that comes out, welcome to the technical aspect and technical side of Forex trading, because this is going to be one of the most intuitive, and it's going to be actually really fun. I myself enjoy doing technical analysis of my charts because it's so vibrant. You can customize things for aesthetic purposes, and also just understanding how they actually help you and your psyche when you're trading. Okay, so what I'm going to do, I'm going to go back into the gold against the US dollar. I'm going to come pretty far back. I'm going to go on the weekly time frame as stated before, and what I'm going to look for is some sort of trend. Now, understanding trend first before you draw the trend line is highly important. Because if you are in fact drawing your trend lines, or you're trying to understand trend in the first place, you're understanding that markets are moving in one of three directions. Okay, markets move up, which is bullish, down, which is bearish, and sideways, which is consolidative, ranging markets. Every market will always have a point of consolidation. Even if their opposite pair is moving. Say like for example, if you looking at the euro against the US dollar, and then looking at the US dollar against the Swiss franc, you may in fact see the euro moving up while the Swiss franc is moving down. Now, there are different similarities and correlations in between those, but the main objective is to understand where exactly those termination points come, and whatever currency you're looking at. Okay, so in this specific part, we're looking at the gold against the US dollar on the weekly time frame. Okay, so what you're looking for is a point or a point you can draw your trends from. Okay, so say if you start from a low into a high and then a higher low right here, this is the highest point. Now what we're going to focus on, we're going to focus on one section. Let me go ahead and put the favorite this for I'm going to be using this a lot. We're going to focus on from here and forward. So anything behind here is not what we're focused on. We're focused on everything that goes forward. Okay, so I'm putting this marker right here so you guys will understand and you'll have a basic idea what we're looking at. So anything from this vertical, this vertical line on forward is what we're focusing on. Anything behind it, not in the system yet. Okay, so how do you draw a trend line and how do you understand trend? Now, if you sat back in your chart, push your chart away or walked across the room and you looked at your chart, the first thing you should be able to do is tell where exactly the market is going. In this case, we understand the market is going up, so we have an uptrending market. Okay, and vice versa, if we stood back and we understood the market was going down, we have a downtrending market. We have a bearish market, a seller's market. Now, currently we're in a buyer's market for the gold against the US dollar, which is pretty good. We're in a weekly time frame. Now, how do we end up drawing our trend line? If you're using TradingView, TradingView has a wide array of tools that really just make trading so intuitive, make it so fun, and make it really easy on you. You know, as a trader, because we do so many things at one time on our chart, especially if you're a technical analysis trader, that you really need to find that niche or that area of relaxation and solidify your place on your charts and make sure that you don't have any kind of clutter going on in your brain. Okay, that's why most of the times you see my charts, they're pretty much blank. Except at the beginning of the video where I had a technique I used that I'll be showing you later in the videos. It's really going to help you out a lot. But going forward, we'll start from this low point right here. Okay, when you're drawing trend lines, you wanna find at least, I would say, a 45-degree dissension of the charts, you know, and that 45-degree distinction looks something like this right here, you know, from right here. You know, it starts at a high and just pivots down about 45 degrees, about 50, man, like 45 degrees, right? So it's kind of abstract of the original trend. So say if you like flip this on the other side of the spectrum, if you like took this area here, this bullish trend right here, and you flipped on the other side, this would be roughly the same degree length. You know, this is probably like a 45-degree ascension. This is a 45-degree descension. Okay, and I can't really eyeball. I can't really put it on the chart because TradingView doesn't have that capability, I don't believe. And if it does, you know, I might be missing out on something, but correct me if I'm wrong. But anyway, it's kind of like an eyeball thing. And usually I don't, this is probably one of the only techniques I'll say eyeball it, because I really don't like eyeball thing. I like using mathematical measurements. So if we're understanding this low and this high, and then this higher low right here, what you're going to understand as a trader is you're going to see, okay, we have a possible rejection away from some horizontal slash lenticular support or resistance. You know, if it was down trading market. So in this case, we have some support, right? An area that the market found a base or a price area that it wanted to work off, and we had a bullish candlestick that got put in place. Okay, now the thing about this is that you want to make sure that in order for the trend line to be valid, it has to have some type of bullish or bearish rejection away from that pivot point, and usually it's a wick like these right here, but we're not going to get into that right now. We're just going to focus on this area. So in this case, our trend line will go from this low to that pivot. Okay, now I know some people are probably thinking, oh, Chris, why don't you take it to this side? Because we're working in chronological order. Okay, so say if you're back here in May 2009, okay, and you drew it from right here, you see we have a false, yeah, but we have probably a false break below, right? So we have a low, we have a high, okay, and we have a bounce right here. We draw a trend line from here. Now, if we were looking back in the past charts, we understand that, okay, the trend is going, and we see something interesting. Okay, we see that it failed to break that previous high. Now, in this scenario, we will probably understand that maybe the market is not going to continue rising. And then we get a bearish candlestick, a red candlestick that engulfs the previous candlestick, kind of like it's actually a bearish engulfing candlestick. And then we see a close below this trend line, this trend line that we thought it was. Okay, so now you know we're kind of in no man's land, waiting for something to come around. Kind of you probably spend a few, I don't know, weeks, months not working on the currency. Then you look at the next point of rejection. And the next point of rejection looks for a more solid area because we see price reacting off right here and right here. Okay, now what we're going to do, we're going to carry that all the way up. And what you're going to see is you're going to see a it's a trend. This is what trend lines do. Okay, so you're going to see a very imminent I'm sorry, very proficient stance on your trend line. You know, we have an uptrending market. We have a true bullish trend. And this is just something you could swing on literally from 2009 and 2011, right? But nobody would really know that until it actually happens, or if you're just a really good technical analysis trader. And my thing is, you need to be a good technical analysis trader because you need to figure out where you are and what kind of trader you are in the first place. And my thing is, you guys, please don't be a fundamental trader. Just follow what the markets are telling you. What I want you guys to do is I want you to practice this. Every one of these videos, I want you to at least practice them two or three times. Go through them two or three times before you actually move on to the next one if you don't understand anything. In this case, this is a very simple method. I would hope you understand it on the first try or the second try. And what we're doing basically is we're understanding we have different points of rejection. So this wouldn't have been valid if we didn't have a valid point of rejection. This is now valid because we have a point of rejection. And if you look a little bit closer in the candlesticks, you see you have a failed close. It did not close below that. If this bearish candlestick is very, very small right here, if this closed below the trend line, what we will have is we have a close below, a confirmed close below, and a possible break of the trend. Now, these wicks that you see breaking the trend line, unless they close below the trend line, you really have no confirmation to go in the opposite direction as of yet. Now, if we look forward into the market, we see the same exact thing. What I'm going to do, get my ellipse tool out right here, right here. And, it's just all over the place. It's great. Like, these are the things you want to look for inside the market that really make it fluid. Okay. Now, when you're drawing trend lines, another thing, because I know back in the day, and probably if you're one of my previous students, you're probably looking at this video like, hey, Chris, that's not how you say drawing back in the day. Well, I mean, things change. You found more accurate ways of drawing trend lines and more correct ways of drawing trend lines. Now, what I'm teaching you now, if you watch my previous videos on how to draw trend lines, discredit that. Unless you're following the method along with harmonics, then you would take that in consideration. Okay. But if you're a new student coming into this, just don't even bother with it. I'll be honest with you. Now, going a little bit forward, we see a close below here, and we see oops, the wrong one. We see a close below right here, right around 2011, May, I think May of 2012. And then we see a bullish engulfing. Basically what this is, you look in the monthly time frame, this is nothing more than a wick, right? This is nothing more than a wick. So now you do have the confirmed close below. You have the rejection away from the opposite area. And the rejection away from the opposite area of the trend line will be these wicks right here, failing to breach the external area. And it's finding resistance. It drops a little bit, levels itself out with previous support right around here. And what you're going to see is you're going to see a rejection away from the external area. And the rejection we see away from the external area is very interesting. And it's very interesting because it goes directly in line. What you'll usually see is you'll see the market break down, close below, reject. The first rejection comes into play. It'll fake people out because some people are definitely looking at what you're looking at. They just don't continue looking at the things that really make sense inside the market. So you'll see a work off some previous support. You see the market rally up. It's still on the external area, the outside area. It'll reject and it'll start falling. Where's your entry? If you want to be like my housemate Quillen, your entry would be up here. But there are multiple different ways. There is no one correct way. The technically correct way would actually be entering at this bearish engulfing candle. But I mean, honestly, nobody wants to do that because you're gonna be focused on like, oh, what's my drawdown? If the market comes back, rallies back up. A better entry would be like right around here. And honestly, if in fact you shorted gold on the weekly time frame and you saw the rejection away from this this external area, I mean, your stop loss is going to be roughly above this high. If you get stopped out on this high, then you have a larger area of profit. Always want to make sure you have your ratios as accordingly. So if you're risking 50 pips, your profit should be at least 100 or 150 pips. That's just right off bat. Okay. Now, what I want you guys to do, I've showed you this. I'll give you one example. I'm going to give you another example so I can show you guys how lucrative this is before we go on. Okay. Let's go to the daily time frame. It'll be a little bit simpler. Let's see. Okay. We have one possible one right here. Okay. Red on the gold against the dollar on the daily time frame. Okay, now this is a really nice one because I want you to see it from both sides of the spectrum. We've already seen the ascending market. Now you see a descension. You have the first point of rejection. You have the second point of rejection. Trend line goes straight through. Well, about right here. Trend line bounce. False close above. Rejection off previous support. And that previous support comes into play right along this area right here. And how do you draw this? You'll find out later in the video. I'm just gonna be honest with you. The only way I can really explain this to you is you watching later on in the video and understanding that every candlestick, every area or zone inside a chart has an area of rejection. And these are gonna be called rejection areas. I think like 3 or 4 videos ahead. Don't sweat it. Anyway, so this right here, we have a confirmed close above, and this will be your entry. Okay, how do you not get faked out? The question, another question would be, how do you not get faked out within a chart like this? How do you not get confused, or how do you not lose money? You know, if you bought the market in technical aspect, if you bought the market here, why would you? The whole idea is to wait for a retest or be patient. If this doesn't look right to you or there's too much complex things going on, don't enter. If you find an area or something that makes sense within the market and understanding how they actually correlate, then enter. Everybody would have loved to enter right here on the gold against the US dollar and catch that major uptrend. But why do people never catch it? This is because people are not looking in the past, making their future decisions. Okay, I know earlier when I said and I drew that vertical line that don't look in the past, but that's just for those trend line purposes because we're now looking into the future. If in this case we're talking about don't look into the past, I would actually be talking about don't look behind here, because now we're making new projections into the future based off what we currently have. We have a nice load of price data right here. We have a nice area we can work off, and we have some nice price action. Okay. Now I've shown you both. Scenarios. What I want you guys to do, I want you to practice this at least 1 or 2 times, as with all other videos. I want you to practice 1 or 2 times, and then come back to me. Work on. Actually, no. What I want you guys to do, I want you to practice this 1 or 2 times. I want you to move on to the next video. I want you to be consistent. Every time you mark up your charts, add new things on there. Okay? Use the techniques that I'm giving you. Okay? I'll see you guys in the next video.